Today's episode is brought to you by Mazars. SoundCartel. As the saying goes, there are two guarantees in life, death and taxes. You can't avoid either, but you can avoid paying more tax than you need to, especially when it comes to the insurance you have. From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Do you, like many Australians, have life insurance, income protection, or TPD insurance wrapped up in your superannuation? It's an easy set-and-forget solution, right? Well, did you know that the ownership of your insurance policy can affect not only the events you are eligible to claim for, but also how much tax you might need to pay if you do claim? That's the important point that Jackie Crane, Life Risk Advisor at Personal Risk Professionals, addresses with her clients. She explains more to Clive Todd, partner at Mazars.
While you might have life TPD or income protection through your super fund, or personally, as with anything, each option has its own pros and cons. However, most Australians pay their premiums each year and aren't aware of any of these.
So how can whether the policy is through superannuation change what can be claimed on? Isn't the policy just the policy?
Yeah, while it's easy to think that actually isn't the case. So when insurance policies are owned through superannuation, they become bound by the SIS Act and superannuation rules that would otherwise not apply. So this changes the rules for what defines an eligible claim, how the claim is processed, and how much tax is charged on claim payments. So in addition to premiums depleting your retirement balance over time, it actually changes the policy terms as well.
It sounds like those are some pretty big differences. Can you give us some examples of how this might actually affect a policy or claim?
Yeah, absolutely. So, for example, let's look at TPD, which is Total Permanent Disability Insurance. When owned personally, TPD cover can be held with what's called an own occupation definition. So this means your eligibility to claim is defined as unlikely to ever engage in their own occupation held just prior to total and permanent disablement. So this is looking at your roles, duties and responsibilities of your occupation. But when it's owned through super, a TPD policy holds an any occupation definition. So this definition is unlikely to ever engage in gainful employment for which they are reasonably qualified through education, training or experience. And some superannuation policies also include the wording to be able to be retrained. So in contrast to own occupation, this looks at what jobs you have done or are trained to be able to do or have transferable skills for. Not only does that make a difference to being eligible for a claim, as you can imagine, it is much harder to meet the any occupation definition, which means there could be a lot longer that you are off work before you're able to meet your claim definition.
So if you wanted an own occupation policy, this obviously definitely makes a difference. But if I was happy to hold an any occupation policy, would it matter that the policy was through super or not?
Yeah, that's a really great question. Yes, it does still make a difference. Because the policy is technically owned by the super trustee, the claim benefits get paid to the super trustee and therefore form part of the superannuation balance. To access the funds, you then must meet a condition of early release of super. This means two things. One, you have to meet a second set of criteria, the early release of superannuation conditions. And secondly, depending on your super balance, age, contributions, and other factors, you can be charged about 22% on at least a portion of the amount you claim. So that's a pretty stark difference to when the policy is owned personally, where the claim benefits are paid as a tax-free lump sum.
So the standouts there are not just the extra paperwork, but also the tax. This could make quite a difference at claim time. Is that just the TPD cover, or is this on life insurance and income protection as well?
So both the life insurance and income protection benefits are, let's say, same but different. So when owned by super, they are also technically owned by the super trustee, but this affects the different policy types in different ways. So for life insurance specifically, this means that if the nominated beneficiary is not a dependent under the superannuation rules, the life insurance benefits will be subject to tax at varying rates depending on the taxable status of the superannuation balance the funds are paid through. Upon death, that's an automatic condition of release. So We won't need to worry about meeting the second set of criteria. For income protection, because this is treated as a replacement of otherwise personal exertion income, whether owned through super or personally, it is subject to normal income tax. However, for income protection, we do need to consider the condition of release rules. Because as similar to total permanent disability, there are different rules around releasing funds from super in the event of a disability. The main differences here are around the gainful employment definition prior to disablement and the definition of temporary disablement. So it does complicate the claim criteria and slows down the claims process, in some cases quite dramatically.
So is there any benefit to having the policy through super?
It is definitely not a one-size-fits-all approach. There are absolutely benefits to super-owned insurance. For example, it eases the pressure on day-to-day cash flow. It can provide a tax-efficient way to pay premiums. And also, cover that is automatically set up with a fund can be beneficial for someone who isn't eligible to get cover otherwise due to medical or financial circumstances.
Well, finally, what can everyday Australians do to make sure they aren't getting caught out at claim time with not receiving benefits or paying unexpected tax?
Getting professional advice. This is the key to understanding your policies and ensuring they are in line with your objectives and personal circumstances. Having a clear understanding of your policies and their terms and conditions is the number one thing you can do. This ensures you know what to expect if you need to claim and there are no or fewer unexpected surprises.
Thanks for that, Jackie. A lot to think about, and clearly insurance is something that should not be taken for granted or ignored, and getting good advice is essential.
Absolutely, Clive. Spot on.
That was Jackie Crane, Life Risk Advisor at Personal Risk Professionals, talking to Clive Todd, partner at Mazars. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.